Hello, everyone, and welcome. I'd like to thank you for attending our second investment power hour. And today we have our guest contributor is Greg Lagasse, who's a partner with EdgePoint Wealth. Before we get started with Greg, I just want to cover exactly what my goal is today for you, our clients. Number one, we want to provide you with information and insights from some of the brightest investment minds in Canada. Number two, we want to provide you with clarity on what's happening and what action is being taken within the funds that you own, because there's been extensive rebalancing and changing of the investments within these portfolios, yet you don't get to see them because they're happening behind the scenes within the actual fund. And finally, we want to simply be available and present to help you through this challenging time. So as far as who's on the call today, you've got myself, Jon Williams, Daniel Greer is here, Megan Andrusiak is also here. She's helping us run this Zoom. And then, of course, we also have our guest speaker, Greg Lagasse. So with that, before we get started, we always welcome and encourage questions. There is a chat button at the bottom of your Zoom screen, where if you select that, it'll send the question in to the panelist group, where then Dan or I will go ahead and ask Greg any questions that have come up. Now, before passing this over to Greg, I wanted to share with you some lessons that I've learned from the managers at EdgePoint, because some of the principles that they use to make investments, I literally use daily myself. One story that sticks with me is from Taipu Sada, who is one of the three principals and founders of EdgePoint. And he talks about the fact that you need three principles and key things when making an investment. The first one is you need an investment thesis. That is, why does this company make sense to own? Why do I want to invest in this? The second is that thesis has to be proprietary and different from what the rest of the market already knows about that business. And finally, you have to know what the price is that you're willing to pay. What are you expecting the value and the future value of this business to be? So to give you an example of these principles, last year when marijuana became legal in Canada, I had many clients come up to me to mention and say, hey, isn't this a great opportunity? We should get into these marijuana businesses, whether they're growers, sellers. You know, this is a new business that's going to thrive in Canada, and when it becomes legal in the US, you know, there as well. So what I like to do is to walk through these three principles. Now, number one, is that a viable investment thesis? Absolutely. I mean, there's no doubt there are going to be businesses that make quite a bit of money within the marijuana industry. Number two, is it proprietary though? I'm going to say absolutely not. In fact, all newspapers all across Canada and North America constantly were talking about the marijuana industry and different businesses. And finally, when we touch on what price are you willing to pay, the fact is that most of those startup companies were losing money. They actually weren't creating a profit. In fact, they had what's called a burn rate, which is a calculation as to how much money you're burning through and how long your business will last before you go out of business and run out of money. See, investing without profits is speculating, not investing. And I often equate the marijuana industry as a reminder as to when I started the business in '98. Which was similar to the emergence of the internet. It's a valid theory that there are going to be businesses that make a whole bunch of money off this internet and this new technology. But is the theory proprietary? No. And number three, who is making money and who is losing money? What's a reasonable valuation? So these are some of the principles that I have learned and do apply on a regular basis. And today you're going to hear from Greg about some of the proprietary insights in investment theses that EdgePoint has come up with and that they're investing in right now. Now, if you take a look at the EdgePoint Global Top Holdings, which I just brought this off the website, it's public information. You take a look at their top 10 holdings, many of these companies you probably have never even heard of, which makes them very, very different from a lot of other investment managers around there. Now, what has attracted to me to EdgePoint when they were first founded in 2008 was the fact that this process and these managers have been following this process for over 5 decades. It was started by Bob Kreml in 1971, this particular process. And so that sort of longevity and consistency for long-term attractive returns is what really brought me to embrace EdgePoint as a company for part of my clients' portfolios. So today I asked Greg to come on and discuss their process and what their thoughts are about the impact of this current pandemic that we're going through, and to share some of these proprietary insights with us. So with that, Greg, I'll let you take over.
Great. Thank you, John. I really appreciate the opportunity to talk to the people you have relationships with. And I guess before I start, I just wanted to say, I know it's a pretty crazy time, so I hope everybody's families are staying healthy and safe. I think before I go into some of the proprietary insights on some of the businesses we own within the portfolios, it might be a good idea to talk a little bit about how we manage money in general. We believe investing is most successful when it's most business-like. So what do I mean by that? Well, let's bring it to something to you and your family. Imagine you're given $2 million. And with that $2 million, you have to do 2 key things. One, you have to buy a business. The second thing, the earnings from that business is the only thing you'll have from now to forever to feed, shelter, and clothe your family. The question becomes, what kind of business would you buy? And I'm fully convinced you don't need a business degree to start to narrow down your universe in terms of what types of businesses you would be looking for. I think, maybe your family sits around over the dinner table and you start to ask yourself questions. And the first thing you'd probably come to is, well, we want a good business, right? We don't want a business that's shrinking or a business that doesn't have a competitive advantage. That wouldn't be too smart. We'd probably want to identify one we think can grow. We probably would narrow down businesses that already had a great management team in place. I'm convinced everybody listening to this website would be looking at the same things if that's the decision they had in front of them. The only thing I skipped in that discussion is, what price would you pay for that business? So let's say you found a good growing business run by really competent people that had a competitive advantage and it was earning $50,000 a year. Well, if you paid $2 million for that business, you paid a really high price. So let me explain what I mean by that. So you paid $2 million for a company earning $50,000 a year. That $50,000 a year is 2.5% of the purchase price. Or put another way, it's 40 years worth of earnings. Or put another way, if you bought that business for $2 million to buy a business generating $50,000 a year, if that business didn't grow, you would need to earn, to earn a return, it would take you 40 years to get your money back. That's a really expensive price to pay for a business. It's something we wouldn't do. It's probably something you wouldn't do. But it's something that we see that happens all the time. If we go to the first chart, John, I have an example of this. So as John alluded to, our investment team was around for a number of decades. They managed through the technology bubble. I'm not sure the age of the people on the webcast, but some of you may have read about it in textbooks. Some of you may have lived it. But in late 90s, early 2000, there was kind of this herding, I guess is the best way, in the market. And it was kind of between old economy, banks, manufacturing, pharmaceutical companies, and new economy, right? Everything connected to the internet, things like Cisco or Nortel here in Canada. And here's an interesting chart. Cisco unquestionably is a great business, and it was touted as a great business back then. It's the plumbing to the internet. And we have a chart of their stock price, and you can see that parabolic curve up to that $80 level, which was the peak of that herding in the technology bubble. And what's interesting, if you look at the rest of the chart, the stock chart, here we are almost 20 years later, January of 2019, this goes up to, so close to 20 years later. And you can see the price is down 40%. And look above the revenue growth, which is the gray shaded area in that chart. You can see Cisco as an underlying business, the revenue growth, it's quintupled. So the business is 5 times greater than it was at the height of the technology bubble. So you were right, you got a great growth business. It was run by really smart people, but look at the price. If you got the price wrong, you can still lose a lot of money. So this is what I mean by we believe investing is most successful when it's most business-like. And yes, you want a good growth business, but you have to be very careful about the price that you pay for that business. So thanks, John. If you want to move to the next slide. So what happened in the market in 2019? So I referred to something on the first example called price to earnings, right? So if you bought a business generating $50,000 in profit and you paid $2 million for it, that was 40 times earnings. That's the price to earnings multiple. And in general, the theory goes, the higher the price to earnings multiple, the more expensive the business is, and thus typically the lower your future return would be. And the lower the price to earnings multiple, the cheaper the business is, or the less expensive, and the higher the future rate of return. So to give you some context for the slide, maybe we can talk a little bit about over the past 100 years in the stock market, the average price to earnings multiple would have been in that 15 to 17 range. So if we could find a great growing business in that 10 to 15 times earnings, that you're paying a cheap price, and that's a good entry price, and should lead to a good long-term rate of return. And if you're paying 20, 25 times for a business, well, that's an expensive price. So here's a list of really recognizable businesses at the beginning of 2019. And you can see that on average, they opened up that year at 26.3 times earnings. Well, from a historical perspective, that's expensive, right? And if you look at what happened through the year, so they finished the year at 35.2 times earnings. Buying at these levels, in our opinion, is crazy. I mean, if these businesses don't grow and you pay 35 times earnings, it's going to take you 35 years just to get your money back. So through the course of the year, people were willing to pay 38% more for these businesses. If we want to fast forward to the next slide, John, to the pandemic now. Go back one, please. So let's talk a little bit about what's happened since the global pandemic has hit. I think what we find in general, and John, maybe you could talk to this, but people's time, in general, a lot of people's time horizons shrink, understandably. Where people used to think 3 to 5 years, they're now thinking 3 to 5 weeks or 3 to 5 months. And when you get into scary times like this, it's natural, but can be dangerous. And I'll walk through this, but it's natural to kind of herd into what we call obvious survivors. I don't think anyone questions the fact that Netflix is a company that's going to survive this pandemic, right? People go home, they watch Netflix. It's relatively inexpensive. They could increase their prices. I know I would still pay. And so we call that an obvious survivor. And if you can see here by their price to earnings multiple, it's now trading at 50 times earnings. Think about that. Would you go out with that $2 million and be paying 50 times earnings? Meaning if this company didn't grow, it would take you 50 years just to get your money back. Yeah, I don't think you would do it. We're definitely not doing it. But that's what's happening in the marketplace, whether it's, Amazon online shopping versus retailers, or Costco, grocery stores. In that vein, everybody knows that these companies will survive. And we would say that that is, reflected in the price. Jon, at the beginning of this call, talked about this concept of proprietary insight. One of the key drivers at EdgePoint, when we commit capital or put capital at risk in buying an ownership stake in a business, is what do we know that others don't? And when it comes to these obvious survivors, we clearly feel that we don't know how these businesses are going to surprise to the upside, or they're going to grow faster than everybody already thinks. And that's kind of priced into the business. So anyway, Jon, if you want to go to the next slide, please. So let's talk a little bit about this pandemic and how it impacts portfolio design or portfolio construction at EdgePoint. There are two key questions that we are asking ourselves with every business within the portfolio right now. And the first one is the absolute key. Will this business survive the pandemic, right? Because if it doesn't, all bets are off. So, let's look out 3 to 5 years. Will this business survive that pandemic? And then if the answer is yes, the key question then becomes, what does it look like? Is it a worse business? Is it as good, or is it better? And I can tell you right off the bat, we're looking out 3 to 5 years and saying, if it survives, that's part of our universe. But more importantly, we want to be in businesses that will look as good as if the pandemic didn't happen, or even better. So, you think about businesses that might be permanently impaired through this. Look at retailers. People might get used to online shopping. So some of the retailers might survive, and I'm sure a lot of them will. But it certainly is tough to figure out which ones will survive. And because so many stocks are down in this environment, why would we need to be investing in companies where we don't have a clear and obvious answer on what they're going to look like on the other side? Look at this working from home or this webinar. I think a lot of companies are going to say, hey, it looks like our employees are pretty productive working from home. Do we need all this office space? Well, that may or may not happen. But again, with so many stocks down, why would we need to be trying to find ideas, investment ideas in spaces where it's hard to handicap exactly what's going to happen? If you look at the far right end of this slide, businesses at the epicenter, cruise lines, airlines, hotels, they're certainly very cheap. And maybe you can find an idea. But I think, depending on how long this goes, some of these businesses might survive. But if it goes on for a long period, some of them may not. So that concerns us. Also, what do they look like on the other end? I think to get through this, they're gonna create some losses right now. We're seeing that. And they're going to have a lot of debt coming out of this. And so they won't be the strong businesses that we thought they were. So we're kind of eliminating, businesses here at the epicenter. We're eliminating retailers. We're eliminating commercial real estate. And I think on the far left-hand side, Jon, the obvious survivors, we talked about that, at 50, 60 times earnings. It doesn't make sense for us to go there as well. So we're kind of in that middle area of the chart. We're saying, can we identify businesses that are generating cash, and they will look similar or better 5 years from now, even if this pandemic didn't happen? I think that's where you're going to see some real opportunity for substantial capital appreciation, right? I think when we go back through our history, there are periods of time where, whether it's fear or greed, that people start to herd into certain sectors. Jon brought up a few. You think about the tech bubble and the Cisco example. People were herding from a greed perspective into these technology names. And we saw an example like Cisco, where you got it right on great management, great growth business, but the price was wrong. And there you are 20 years later, still down 40%. We saw fear herding in the 08-09 crisis when EdgePoint started. We've been here before as a company. Again, back then, instead of capitulating and flocking with the herd to the obvious survivors, we said, hey, if we can dig deeper and find companies that are just as likely to survive as a Costco, as a Netflix, as an Amazon, but they're priced like they have no future. That's where we're really going to find some substantial opportunities to generate great growth and capitalize on the volatility that's happening in the market. So, Jon, if you don't mind, I'll pause to see if there's any questions or comments, but I could maybe walk through a couple of examples of some of the non-obvious survivors we're investing in. Does that sound okay?
Yeah, that sounds good. Do you want me to pull up these top holdings to
Sure.
reference?
If you want to go back to that chart, Jon, that'd be good.
Sure. Yeah, I think I definitely like you to share with some of the couple of the ideas here in your top holdings on why they're not an obvious survivor, for instance, and or why they might be a better opportunity than other people think right now.
Perfect. Okay. I'm going to start with Berry Global, which is number 9 on the list. I think this is a story that resonates very much with me, and I'm hoping it will with your audience. But Berry Global is a packaging company. It makes products such as food packaging, the plastic liner in diapers, components of surgical masks, and medical clothing, protective medical clothing. The stuff everybody's seeing on TV today, the personal protection equipment that the frontline responders are wearing to protect themselves from COVID-19. And what's interesting, let me start with the valuation on this business, Jon. It's generating an 18% free cash flow yield. Now, let me explain what that means. It means after it pays off everything, salaries, all the expenses related to the business, what's in the bank at the end of the year. It essentially means you could collect an 18% dividend on a company like this, which means you can expect an 18% rate of return pre-growth. Now, in terms of growth, we also think this is a growth business as they doubled their earnings over the past 5 years. Pandemic.
Greg,
yeah.
Greg, on one point there, just to tie back in your previous example as a business owner,
Yes.
to put things in perspective for people, if you had your $2 million and you were to buy the business entirely on your own, in Greg's previous example, where he said out of 40 times price earnings, you'd only be getting 50 grand a year, an 18% cash flow yield on this business would give you $360,000 a year in income.
Quite a difference, right?
Yes,
and that
and
was
that's the free cash
at
flow.
40 times earnings, and we're seeing businesses in the market today at 50, 60 times earnings. So that's a great analogy, Jon. Thank you. So here's a business that your family could buy with $2 million that would be generating today $360,000 in a dividend payment essentially to you before any growth. And again, as I mentioned, this business has doubled its earnings over the past 5 years. We've sat down with management. We've done a deep dive in the company. This pandemic has a neutral to net benefit to the company. You think about packaging and plastic liners and the plastic and the surgical masks, et cetera. The biggest input cost to this business is resin. The biggest ingredient in resin is oil prices. We all know what's happened with oil prices. So that's dramatically dropped their main input cost. They've announced their earnings at the end of March, and they were in line with what they forecasted and reaffirmed that they're, even in this pandemic, well, certain lines of the business are going to have a tougher time. Things like the protective equipment are doing even better. And so it's a net neutral impact. So what's the opportunity here? Why is the market not seeing this as an obvious survivor? I mean, we clearly see it as an obvious survivor. Well, long story short is they made an acquisition last year and they took on debt to do it. It made them the largest player in this space globally, but the market is worried about the debt that they've taken on. Now, we've again done a deep dive with the management, met with them as recently as 2 weeks ago, and they're taking that cash flow they're generating and they're aggressively paying off the debt. And I think at some point in the future, the market will recognize that this is an obvious survivor and will probably see it repriced, meaning the stock will substantially appreciate going forward in the future and will generate a very good return on this. So any questions before I move on, Jon, to another example?
Actually, yeah, we do have a question. It's the question is, so long term, are you pessimistic on real estate companies and REITs? What will the impact be on any large property users such as car dealers, et cetera?
Well, Jon, I think, we talked about a little bit about this before. REITs, for those of your clients who don't know, it stands for Real Estate Investment Trusts. And REITs package up all sorts of different ways. They could be grocery stores, they could be medical clinics. John talked about one last week he discussed. That was the cell tower properties for our mobile phones and the internet. So there's all different types of REITs out there. So it's hard to give a blanket statement. I think what I was saying earlier, John, was this work from home trend that we're seeing. We think it may cause some companies to realize how productive their employees are at home, and maybe they don't need as much office space as they currently have. Now that may happen, may not happen. The point in mentioning that is, why have that in your investment universe when there's that kind of uncertainty around the outcome of this pandemic, when there's other companies like Berry Global where there is much more certainty about the outcome. And so because so many stocks are down in this environment, why don't we move to the ones that have a lot more certainty going forward? That's what we meant. Does that make sense?
Yeah, so it's not necessarily that they're all bad or that they're not going to be okay, but you simply are utilizing the funds and the money that you have to invest in something that you have more upside potential, I guess.
Yeah, let's say maybe similar upside potential, but less downside or more certainty.
Fair enough. Yeah.
Fair enough.
Interesting.
Okay. There's another name on that list, Flowserve Corporation. Flowserve is a very interesting business. If I take a look at my notes here, it's one of the largest manufacturers of pumps, valves, and seals in the world. It provides that to a variety of end markets like water, chemical, power, energy, and the beverage industry. Here's the key. 85% of its profits are simply replacing and fixing the pumps that it has already sold. This business has been around for 225 years. So by my math, it's been through at least one pandemic, if not two, but it's been around for 225 years. And because they've been around for that long, they have the highest installation base around the world of pumps, valves, and seals. And if you think about it, 85% of that business, the lifeblood of that business, is simply fixing or maintaining existing pumps, valves, and seals. So if you're running a chemical plant and you need to replace a pump, you don't wait for the pandemic to be over. You replace that pump. Now, you might maintain it longer, right, and not replace it necessarily, but still, Flowserve is getting that maintenance business as well. And ultimately, it will be replaced. And you go to people you trust to get that done. So 6 times earnings for this business, John, in an environment where we see things at 30, 40, 50, 60 times earnings. I think to summarize, we look at this company as an obvious survivor, but it's priced like a non-obvious survivor, meaning we're getting all that future growth for free. And again, these are the kind of opportunities you get very rarely in the investing world to really generate substantial capital appreciation. You know, I could look at number 3 on that list, Swedish Orphan Biovitrum. It certainly is a mouthful to say. It's a Swedish biotech company. They basically help hemophiliacs manage that blood disorder. And unfortunately, that's a growing business. But today, it's generating a 10% free cash flow yield. So again, before any growth, 10% dividend in your pocket. You know, that's, again, pretty attractive to us. So I don't know if you want me to go on to other examples, John, but maybe I can pause there just to see if there's any other questions.
With the Flowserve Corp, I think I've also heard that that the reason why it's sold off, I guess, more than some of the other businesses is because of its perceived exposure to oil and gas.
Well, yeah, it has about, you know, mid-single digit, call that 7%-ish exposure to oil and gas exploration and production, those upstream companies that are actually looking for, finding, and producing the oil. And that's obviously a concern for the market. But again, we look past that and say, with 85% of the business coming from maintaining and replacing their existing installation base, it's been around for 225 years, which is the largest in the world. It's high margin business. It's the lifeblood of this business. There is no question this will survive to get to the other side. But a portion of their business is being impacted on the oil and gas side, yes. And that's the overhang, but that's what creates the opportunity.
Dan, I think there's another question here.
Yeah, that's great. So, Greg, I've been a long time EdgePoint supporter, and I've seen many of the top holdings. I know you guys have owned Shiseido for a long, long time.
Yeah.
Could you talk about how different the portfolio is today with some of those COVID ideas compared to, say, 6-8 months ago?
Yeah, a good question, Dan. I think it's fair to say that the investment team has been busier than they ever have been in the past couple of decades within the portfolio. So I mentioned we asked two critical questions. Will it survive? And if it survives, what does it look like after the pandemic? In that process, we found three businesses that represented about 5% of the portfolio, to give you some context, that we felt while they would survive, they certainly would come out much weaker businesses. Those businesses were sold in the portfolio. And on a year-to-date basis, we've seen 7 new businesses come into the portfolio. And that's a huge number for a firm that runs concentrated portfolios. You know, typically we have, call it 30 to 35 businesses within these portfolios. So to have 7 come into the business into the portfolio since the beginning of this year is a very high number for us. We tend to buy, you know, good businesses that are underappreciated and hold them for 3 to 5 years. But in this environment, again, when things are this volatile and so many things are down so much, for example, everyone on the investment team has a dream list of the best growth companies in the world they'd love to own. Let's call it 50 names. When you hit this kind of volatility, they all revisit that dream list just to see if there's any great wealth compounding, high quality businesses that are now being priced where we're not having to pay for that future growth, that are going to survive this pandemic. And they're going to survive it and come out the other end just as healthy as they would if the pandemic didn't happen. So, you know, I can tell you that one of the businesses we bought, we've been following for 20 years, which is a staggering amount of time. A great high quality wealth compounding business, but always been kind of priced reflecting the growth that we saw. So we didn't have any proprietary insight. We didn't have an idea on why we were getting that growth for free. But when you get this kind of volatility, it gave us a chance there. I know another 2 of them. One has been on a watch list for 15 years, and the other one's been on a watch list for 13 years. So, you know, we've also looked at companies we've owned in the past that we've sold because valuation was very high, not because it wasn't a great growth business. And some of those things have made their way back into the portfolio, as well as a few other brand new names that we've, you know, never owned before. So there's been a lot of change. Does that answer the question, Dan?
Thank you. It certainly does. And it's great input to speak to EdgePoint's core values, and that you've watched them that long and been waiting for either the price point or the proprietary information.
Yeah, great. Thank you.
Well, I think at this point in time, then I think we'll wrap it up. Greg, I will go through your other 2 slides here while I'm wrapping up, because they're required from a compliance perspective, but these are the funds that they manage and that we've referred to. So I'd like to thank you for providing some insight and some really unique investment ideas on where the portfolio is and how you generate some of those ideas. It definitely gives us more clarity on where EdgePoint as a asset manager is coming from, and as well as the action that's being taken. I do find it very interesting that you do have that 7 brand new holdings. That is a substantial amount on such a concentrated portfolio. So as always, if anyone does have any follow-up questions, please feel welcome to give us a call or send us an email. And Greg, again, I'd like to thank you very much for coming on today. And everyone have a great, safe week.
Thanks, John.